Alright, so let's say you want a solid passive income that grows while you sit back, sip a coffee, and occasionally check your bank balance. But there's one small issue. You only have $50 a week to start with it. Is it possible? Let's see. Let's map this out. The goal is to retire early with a steady stream of passive income. The challenge? We only have $50 per week to invest. So how can we turn that small weekly amount into a hefty $5,000 per month? All we need is a little discipline, consistency, and patience. Let's break down exactly what you'll need and how to make it happen. Now, before we kick this off and you're swimming in cash, make sure to subscribe. It's free, unlike all those online courses that cost more than your rent. And it'll help you keep learning new tricks for that financial freedom we're all hunting down. Who knows, maybe subscribing will boost your net worth, or maybe mine. Anyways, let's jump in. All right, so let's get fancy. The DRIP investment strategy. Sounds technical, but it stands for Dividend Reinvestment Plan, which is basically a way to use dividends to invest it again and get more shares. Before we get into DRIP, let's understand what is dividends. Imagine you co-own a rental property with a friend. You both put money into buying and maintaining the property, and each month the tenants pay rent. After setting aside some funds for expenses, repairs, and emergencies, you split the leftover profit. Let's say you each get $500 a month as your share of the rental income. This monthly payout is a return on the money you initially invested to buy the property and maintain it. That $500 you receive regularly works similarly to a dividend. It's a reward for your stake in the property. The more properties you own or the more your rent increases, the larger your payout becomes over time. In this way, owning a rental property is like owning a dividend-paying stock where each share gives you a small portion of the company's profit. If you want to learn how to start investing in stock market as a beginner, you can check the video in the corners or also in the description. I have a full step-by-step guide. Now let's say instead of the rental property, you buy shares in a company like Home Depot. This is just an example, not an investment recommendation. Home Depot, as you probably know, is a huge company that makes profit by selling hardware, tools, and home improvement products. They share a portion of those profits with their shareholders by paying dividends. So if you own Home Depot stock, you receive a regular payout, let's say around $2.25 per share per quarter, as a thank you for being part of their business. Now, as long as Home Depot keeps making money, you keep receiving that payout. This dividend income can grow over time if Home Depot decides to increase the dividend or if you buy more shares. This gives you a steady passive income. Here's how DRIP works. Instead of cashing out the dividends Home Depot pays you, you use that payout to automatically buy more shares of Home Depot. In other words, you're taking the earnings you receive and putting them right back into the business by buying more stock. Think of it this way. With every dividend payout, you're reinvesting in your own business. When you own shares of a company, even a small amount, you actually own a piece of that company. Even if it's just $5 worth of shares, that's still a real ownership stake. And each time you reinvest through DRIP, your stake in company grows a bit more, helping your investment compound over time. By using DRIP, you're basically turning a tiny snowball into an avalanche of cash, because each time you reinvest, it's compounding. It's like adding an extra scoop to your ice cream each time you take a small lick, just with money. The more you reinvest, the more it grows, and it just keeps going. Now, if that doesn't get you excited about your financial future, I don't know what will. So if you're enjoying this journey into the world of dividends and investment, why not show a little love? Hit that like button. Your thumbs up helps the channel to reach out to more people who might be interested in topics like these. Now, what are the benefits of DRIP? Number one, compound interest. As I mentioned before, think of it as that snowball you start with on the hill. You roll it down, it picks up more snow, and by the time it's at the bottom, absolute unit of a snowman. Number two, dollar cost averaging. Now, what does this mean? Instead of worrying about timing the market, DRIP lets you invest consistently over time. You're buying shares regularly, and sometimes you catch stocks on sales. Other times, they're a bit pricier, but it all averages out. Here's the bonus. No need to obsess over stock prices every day, unless you prefer the stress wrinkles. Now, part two is the $50 weekly investment plan. So let's talk money math. $50 a week or about $200 a month. Not too bad, right? Instead of splurging on that fancy dinner you keep telling yourself you deserve, you're setting yourself up for $2,400 investment per year. Or to be exact, $2,600 per year if you're investing weekly. And you don't have to give up on something. It's just 1 to 2 dinner in a restaurant. Here's why $50 per week investment rocks. Number 1 is frequent investments. With $50 every week, you're buying shares more often, which keeps dividends flowing. And since the market fluctuates, you're sometimes buying shares at a discount without needing to camp out for a big sale. Second is easy to budget. Look, $50 a week is again that 1 to 2 dinner you skip or a couple of app subscriptions. And it's automated, so you don't even have to lift a finger after setting it up. Plus, you're getting an exposure to the market without a massive upfront commitment. Super easy. If only we could automate the rest of our lives. That is not easy. Part 3 is choosing the right stocks. Here's where you'll want to put your money to work. Not all stocks are created equal, and some are better for long-term gains than others. So how do you pick? So there are 4 categories of stocks you can pick from. Number 1 is blue chip dividend stocks. These are the big names, the reliable rock stars of the stock world. Think Pepsi, Procter & Gamble, or Home Depot. These companies have been paying dividends for clockwork of ages. They are as stable as that friend who always shows up with snacks, reliable, dependent, and always delivering when you need it. Number 2 is dividend aristocrats. Sounds fancy, but it just means these companies have increased their dividends for at least 25 years straight. So if they can navigate recessions, wars, and who knows what else, chances are they can keep you comfortable too. For example, McDonald's, Walmart, ExxonMobil. Number 3 is high yield dividend stocks. These have above average dividend yields, meaning you get more cash back, but they're also riskier. Since these companies pay out higher dividend, they don't usually have enough left to reinvest in their business, which can result in slow business growth. For example, Realty Income Corp, AT&T, Verizon, they may be riskier, but they can add some zing to your portfolio. Number 4 is growth-oriented dividend stocks. A blend of stock growth and dividends. They are like the multitaskers for your portfolio. Companies like Apple, Microsoft, Costco, they are growing their businesses while paying dividends, meaning you could see some solid gains over time. Now you must be thinking, who has enough time to keep tabs on all this? And that's fair. You don't have to, and maybe you shouldn't. And that's why index funds are so popular among investors. By investing in an index fund ETF, you're investing in a bucket of stocks without doing any particular stock research. It's also known as passive investing style. And one of the best dividend ETFs is the Schwab US Dividend Equity ETF, or SCHD. By putting money here, you're investing in a basket of these dividend stocks all in one go. This ETF tracks the Dow Jones US Dividend 100 Index. This index is specifically crafted to follow high dividend US stocks that have a solid track record of consistent dividend payments and are selected based on strong financial performance compared to their peers. So investing in this ETF covers all the essentials for choosing quality stocks with a tiny expense ratio of just 0.06%, which means if you invested $1,000 in this ETF, it will only cost you 60 cents as fees for the entire year. Plus, this ETF has averaged over 10% annual return since inception. It has beaten S&P 500 during the market downturns, which is probably the most popular index in the world right now. This ETF checks all the boxes we talked about: quality stocks, solid dividends, great price appreciation, and low fees. Plus, it has a dividend yield of around 3.6% with an amazing dividend growth rate. And get this, if you put that same $50 per week into SCHD, you're looking at $2,600 a year in investment. But here's the magic. If you keep this up consistently using DRIP and stick with it for 30 years, your dividend income could reach $31,000 a year. But wait, that's not $5,000 per month. I know, and here's where power of compounding kicks in. If you just stay invested for 5 more years and suddenly you're making around $60,000 annually in dividends alone, and your portfolio would be around $1.6 million. Patience is the most important for compounding effect to kick in. They don't just say time is most valuable asset for nothing. Whether you're trying to build a great body or huge wealth, you need time with consistent effort. And before anyone screams inflation and loaf of bread would cost $1 million in 35 years, let's chill. Adjusted for inflation, that's around $675,000 in today's dollars. And it's still a lot better considering you only contributed $50 per week and $91,000 in total. So here's the plan: $50 per week, DRIP strategy, solid ETF, or some carefully chosen stocks if you're very smart and you've got a lot of time to do the research. But most importantly, the beauty of time. Keep your investments automated, consistent, and let them grow. By the time you're ready to cash out, you could be looking at that nice monthly $5,000 per month without much hassle. Now don't forget to share this with your friends and family, because maybe next time you'll be the one giving tips on how to build wealth over a cup of homemade coffee. See you in the next one.